Hello, and welcome to part 3 of our Elements course with How Money Works. I am so excited to share this information with you today. And before we begin, I'm going to show you a quick video talking about the book that all of this is based on, How Money Works, Stop Being a Sucker.
More than 5 billion people around the world continue to struggle with money and financial illiteracy.
It's Madison Avenue manipulation, right? It's been going on for years and we buy into it.
How bad is financial illiteracy?
It's not taught in schools, so people don't know this naturally.
Oh, you're right.
So you grow up not knowing anything about it. You make a lot of mistakes along the way, and we're hoping to educate them and teach them how money really works so they can learn the cause and effect of all this.
And it doesn't have to be generational.
Exactly.
No,
Exactly right.
break that cycle.
Once you understand the basics of financial literacy, it changes your life. The secret is financial literacy. I mean, teaching your kids how money works.
I think it's really understanding how money works.
Once they understand the basics of how money works, they shouldn't have to struggle for very long.
Steve Siebold and Tom Matthews are the authors of How Money Works. Stop being a sucker.
Money means possibility. It means opportunity. It means freedom. Things you've always wanted to do, dreams that you have. Money makes it possible.
You know, of all the interviews we've had in the last 6 weeks, I'm actually most encouraged by that one.
It is so great to have you with us here today. My name is Daniel Miller, and I'll be your financial educator for the next half hour. Again, I'd like to welcome you to the How Money Works Elements educational series taught on Zoom. This course is based on the groundbreaking book, How Money Works, Stop Being a Sucker, now with over 500,000 copies in print. How Money Works is the first financial education book that anyone at any age can enjoy and benefit from, whether that's age 10 all the way to age 100. And speaking of the number 100, the book has now been featured on over 100 prominent TV shows, including CNBC, CBS, ABC, and Fox. It's also received a rare endorsement from the Heartland Institute of Financial Education, and it's been reviewed and referenced all over the web. You can follow them on How Money Works Official on Instagram for practical tips and helpful resources. And if you haven't received a copy of this book yet, let us know when we finish and we'll make sure that we get you one. Our class today is the third of the 5 elements titled Protection. And once you complete all 5 elements, you again can earn a certificate of completion that's signed by the authors as well as myself. And if you attend any one of these, you can take advantage of a free 30-minute consultation with one of our How Money Works experts. They are trained specifically to help you chart a course to financial independence using our 7 money milestone methodology. So we're going to talk about protection tonight, and we believe that your income creates your wealth. This is why the second of the 7 money milestones after boosting your financial education should be to protect your income. So let's get started. We're starting this class with proper protection. Milestone number 2, for an important reason. You need to protect yourself and your family from a possible future loss of income or savings before you chart the rest of this journey. If you were to pass away prematurely, your family could be left without your income in addition to being without you. And your current savings might not be enough to take care of them. Protecting yourself is more important than protecting your property, as Thomas Paine put it. You might not be able to fully protect yourself from illness or accidents, but you can protect your income and your wealth. Ironically, protection of your financial assets is called life insurance. It's a defensive strategy motivated by a sense of love, responsibility, or both. How much life insurance should you have? The answer is that it's different for everyone based on your situation. However, as a rule of thumb, we recommend that you consider having life insurance coverage that's at least 10 times your annual family income. So as an example, if you earn $50,000 a year, you should consider $500,000 in coverage. At a conservative 5% rate of return, that $500,000 would replace about half of your income if you were no longer here. For a more specific calculation of your family's needs, ask your financial professional. Together, you can consider factors like how old you are, how much debt you have, your health, your number of dependents, your role in your business, and your overall financial situation. Many people like Dana here didn't know that 10 times your income was just the starting point for protecting your income. It sounds expensive, but you need to look closer into it before you decide you can't do it. You may be pleasantly surprised. The same people who underestimate how much life insurance they need have a tendency to overestimate how much it will cost. Both assumptions can keep families from putting proper protection in place. As Insure.com says, only 59% of Americans have life insurance, and about half of those are underinsured. So we only have about 30% of the population that has the right type and the right amount of life insurance, leaving 70% of Americans unprotected without the proper protection they need. So you and your financial professional should cover your short-term and long-term debts and any other outstanding loans, your financial goals, your mortgage or rent payments, how old your children are, and how much their education should cost. Just like with so many things, life insurance, with all the different options that are out there, it can seem complex at first, but once you know a little, it becomes far simpler. To start, it's important to understand that all life insurance usually falls into two basic categories. One is temporary, the other is permanent. Let's look at term life insurance or temporary life insurance, which provides coverage for a specified period of time, like 10, 20, or maybe even 30 years. It is the most affordable life insurance available because it provides one core feature, a death benefit, which is the money paid to the beneficiary when the insured dies, and because it expires after the term has completed. With term life insurance, it's possible to have financial protection for your family or business with a relatively small monthly payment. This can make it a fit for anyone with a limited budget during times of highest financial responsibility, like raising your children, paying off things like your mortgage or college, and running your company if you're a business owner. Really important to have some or the proper protection when you have the highest financial responsibility, like we've outlined here on this slide. So what happens when the term on your insurance ends? Well, there are two scenarios you can look at. Scenario one is that if you don't need coverage anymore, you can simply let your policy end. No fuss, no muss. Easy, automatically done. But what if after your term, you still need coverage because you're paying off your home or you're a single income couple? Or maybe you're supporting grown children or grandchildren, or you're still running your company. For these reasons and many others that I didn't mention, you might consider scenario two, which is keeping term insurance. If you're in good health or your term policy has guaranteed insurability, you might be able to renew your old policy. Remember, if you want a completely new term policy, you have to qualify medically again. If you can't qualify, a new term policy might not be an option. If you do qualify, The new policy will cost much more because of your age. The older that you are, the more expensive new term life insurance will be. So this is a concept that we call the financial X-wave. In our younger years, which is represented in the blue on the left, you typically have more responsibility and less accumulated wealth, right? You're getting started in life, so your responsibility for providing and taking care of your loved ones is very high, but since you're getting started, you don't have as much money. In your later years, which is the yellow side, the plan is for your accumulated wealth to increase as your responsibilities hopefully decrease. Term insurance is typically most useful when your responsibilities are higher and your wealth is lower, the left side. If these two factors flip later in life as planned, term insurance becomes less practical. Again, your financial professional can help you look at how the X wave could be applied to your situation. Now, let's take a look at permanent life insurance. Like term, it provides a death benefit to protect your family financially. However, permanent insurance is designed to be kept and protect you for your entire life, not just a period like a term. Think of permanent insurance as a lifelong strategy that can protect your family today and secure your wealth in the future and provide for your family after you're gone. There are three important benefits of permanent life insurance. Number one is life insurance protection for your entire life. Two, with many permanent life policies, not all, but many of them, you can actually add a long-term care rider as an optional rider. And number three is your accumulated cash value, which can give you flexibility with the premiums. This means if you ever can't pay your premiums for some reason, they can be paid out of your cash value. Other benefits that can be included with a permanent life insurance strategy can be advantages like absolutely no market risk, long-term care coverage, tax-free growth, tax-free income, and a tax-free legacy. Avoiding taxes is extremely important to consider because it can directly and significantly impact how much money you'll live on in retirement and the amount you'll leave your heirs. So let's talk about what the cash value component of permanent insurance is and why it can be so important. So a portion of your monthly premium is set aside in an account that grows over the life of your policy. The money in that account is your cash accumulation, and it can be used to fund future purchases. You see a few possibilities on the screen there. In addition to no market risk and tax-free growth, income, and legacy, as we just mentioned, life insurance cash value can also be creditor-proof, meaning creditors can't come after it. When you look at them all together, the advantages of the cash value benefit are very, very powerful, and often they're very much misunderstood. So we saw that long-term care can be added to a permanent life insurance policy as a rider. So let's talk about the importance of long-term care insurance for a moment. You may not know this, but 70% of people over age 65 will need some type of long-term care services and support at some point in their lifetime. In other words, statistically, you will likely need it. But here's the thing, only 8% of people over the age of 55 have purchased long-term care insurance coverage. That sounds like a possible problem and an expensive one, just waiting to happen. Long-term care or LTC insurance coverage helps cover out-of-pocket expenses that can really add up. It can be used to pay for qualified services like nursing home care, home health care, assisted living care, or adult daycare. And you never know if or when you might need it. And if you do need it, the average long-term care need, if more than 1 year, last 3.9 years. As you can see here, the average total cost can be a crippling expense if not covered by a policy. The cost without long-term care coverage could drain one or more of your saving assets you are counting on for the future. So, which long-term care option would you purchase? Well, there are a couple different options you should look at. The first is a traditional standalone policy. And even if you don't have life insurance, you can go directly to an insurance company to purchase a standalone long-term care policy. Or you can opt to add a rider to your permanent life insurance policy. If it's available for your permanent life insurance policy, you can add long-term care protection to the policy in the form of a rider for an extra cost. Everyone should look at this option because each have their own pros and cons. If you go with option one and buy a traditional standalone policy, there are a few things you should know, like the fact that premiums start low, but insurance companies can raise rates on them. Also, you usually pay for care up front out of your own pocket, then get reimbursed, which can be seen as an inconvenience during a very difficult time. Another thing to keep in mind with a standalone option is that you could spend thousands on premiums and get nothing back in return. Although there is a 70% chance that you'll need long-term care, there's also a 30% chance that you won't. Or you can go with option two and choose to add long-term care rider to a permanent life insurance policy. A key advantage of this option is that life insurance companies typically don't raise rates for life insurance policy holders. Some insurance companies, after a waiting period, will pay you money to cover your long-term care expenses, which you can spend however you see fit. There's no need to submit receipts once the eligibility requirements have been met. So coupling your life and your long-term care protection can be a really big savings when you do it this way. And if you are one of the lucky 30% who ends up not needing long-term care, your premiums aren't wasted because your family will still receive a larger tax-free death benefit when you pass away. So long-term care riders aren't the only riders available. You can also consider other living benefits like critical and chronic illness riders that can save the day if you face any of the health challenges like you see on the screen. You should discuss adding these riders to your permanent life insurance policy with your financial professional. Some are inexpensive or even cost nothing extra to add. So as I've shared before, our mission is to teach 20 million families how money works within the next decade. We're going to stamp out financial illiteracy as it relates to foundations and as it relates to money concepts, and now as it relates to protection. We're going to stamp that out in every community. And that's a huge undertaking and one that's going to require an army of thousands of How Money Works educators. So we are looking for people to help us teach these classes and get this word out. And that's where you or somebody you know can come in. If you have an interest or someone you know you think would be good teaching these classes and helping people, please let us know and connect us, as we are going to need a lot of help in order to fulfill our mission. So we're at the end of today's element, and I'd like you to think about which concept resonated with you the most. That's why we started on this mission of eradicating financial illiteracy. This is how you can start to take control of your finances. We call it the money discovery. Part of attending this course is we can help you if you don't have a financial professional yet. This works like driving directions on your mobile phone. There's 2 points of reference that you need. One is where you're at and one is where you're going. The same is true when it comes to your financial roadmap or your protection strategy. All you need to know is where you're at, and our How Money Works educators and experts can help you figure out how to get where you want to go. And the How Money Works discovery in the book can help you take care of that. So our experts are available to sit down with you now that you've attended one of our Elements classes. The question is, how do these concepts work with your financials and your personal numbers? And how much faster will you be able to complete the 7 money milestones when you have an expert guiding you? Your discussion will be private, short, and focused exclusively on your financial goals. So if you're interested in this, our experts can crunch your numbers, make recommendations, and give you access to the best products and services available. Text me right after this class, and let's start putting your money to work today. You can text me at 419-606-9868. Again, that's 419-606-9868. And I'd be happy to connect you to myself or someone on our team that can help you go through this process. So if you liked what you learned today and would like to know more, you can follow How Money Works on Instagram at How Money Works Official for more practical tips and helpful resources. Or you can follow me at Daniel Miller TFA. I post a lot of great content and would be happy to see you over there. Thanks again for joining us tonight. This concludes class 3 of our Element series. We'll see you next time on class 4. Take care.